Good afternoon, everyone, and welcome to the next installment of our Market Matters series. For today, we were able to find another great guest speaker in an area of the markets that I particularly find interesting. His name is Mike Townsend. Mike is a VP with Charles Schwab and Company, where he focuses on legislative affairs. We felt that with all the recent changes from Congress, as well as likely to be passed changes, we thought it'd be good to hear from an expert in the field that might be able to bring a different voice to the conversation. So, and in that line of thinking, and from an expectation standpoint, the Market Matters will probably run a little bit longer than the normal 30-minute interval. So just by way of expectations, I'll probably do some talking for the first 10 or 15 minutes or so, and then Mike will pick it up probably midway through, and then we'll go another 20 or 25 minutes depending on time. Similar to prior Market Matters formats, we're going to talk through just some recent developments on the COVID-19 and where that's impacting things, what we're seeing on that front. We'll talk through briefly some of the economic and investment updates that we've been keeping you apprised of as we've been going on. And then Mike will pick it up and talk about economic implications of the HEROES Act potentially, and then also some interesting legislative dynamics or congressional dynamics that are going on right now within Washington. One of the takeaways here is that while the developed world is in fact seeing a decline in some of the cases, certainly in some of those heavy hit areas like Italy, Spain, Germany, some of those other areas, there's being an offsetting wave of infections that are occurring in the emerging markets. And you can see that very clearly here in places like Russia or even Brazil. Brazil is really a bit of a troubling situation given some of the rapid infection rates that are occurring there. And then even probably more troubling is places like Iran that are getting their second wave early. You can see that tick up that's occurred here. US and UK are tapering off in their number of, national figures, are tapering off in their number of new cases, but it's still, at least from what I can tell or what I've read, not necessarily rapid enough to prevent or fully be confident that we're not going to be hitting a second wave. And that, I think, is probably the big risk to maybe the markets here, is that a vaccine doesn't come quick enough and that a second wave takes hold in certain places that therefore spreads further. But certainly we're still a ways off from that happening. Just some dynamics that we're monitoring, which is why I think it's pretty important to keep an eye on some of this data. Good news, of course, is that in the US, the testing rates are really starting to ramp, and this was, I think, what was promised by health officials back in April. But it does appear that we're starting to get to that level of testing that really is starting to have an impact to make people feel good, at least that the number of tests being done is adequate. And I think, just by way of reference, we're still not there yet. If we were to do as a percent of our population as many tests as, let's say, Germany, for example, we'd be at about the 800,000 mark or million mark. So we're still roughly halfway there, but there might be some mitigating factors as to why we don't necessarily need to achieve that particular level. That could be with, social distancing measures, isolation, or other medical treatments that come about. But you can also see here the percent of the positive results is actually starting to decline as well too, which it would be another prerequisite to see as the number of tests ramp up, giving confidence that we're capturing the number. The actual number is actually going down, which is good. Moving to some of the economic and investment updates. Got some good feedback on this chart because I think it does help lay out where we think opportunities are or changes that we've been making in our portfolios. And you can see nothing really has changed from last week. I just keep these previous views on there because they were previously held. And recall that we did upgrade real assets, things like real estate on the REIT side, to a attractive stance. And we have added a REIT strategy to some of our alternative strategies. Developed market equities in Europe are becoming more attractive given their substantial underperformance of the US. And I think, as you may recall, we've had a pretty large overweight to large cap US, which we still find very attractive throughout all this, because frankly, it's probably these companies, this category of companies are best able to weather the storm in a lot of different ways, whether it's, workforce adjustments or balance sheet capacity or ability to borrow at very cheap rates, things of that nature. Moving to just some of the portfolio notes, I don't think much has really changed other than, we are actually creeping up on this 3,000 number on the S&P. So what my point here is that we'll likely be rebalancing sometime this week, and we've already started that process in some of those strategies. So really it's going to be, I think, and again, this is a really good opportunity to highlight why we're doing this. We rebalanced our accounts when the market was down, 25 or so % on March 13th, adding back to equities, selling fixed income because of the relative performance differentials. And now we're looking to reduce equities back to the target position, adding to fixed income or an ultra short-term bond fund to keep that in cash until we find another opportunity to redeploy capital, especially if we think that we're going to be either in a sideways market with a bit of a retest of the lows from March. On the equity side, we still haven't changed a whole lot here from last week, meaning that still favoring active strategies. We just approved a new large cap growth strategy for those benchmark funds that we're using to replace some index exposure. We're now actively looking at value funds to look to replace some of our value index exposure. And we've come up with a really good short list on that front. Not much has changed in fixed income, and I already mentioned the change we made on the alternative side. Let's see here, moving to earnings, it's still quite a bit by way of earnings are coming out this week. This morning, you may have seen Walmart and Home Depot reported some pretty amazing numbers. A lot of that, particularly in the case of Walmart, being driven by their online channel. I think their online sales number was up 70% year over year, 7-0. And actually, believe it or not, their in-store sales were up, I believe it was 10 to 12% year over year. Home Depot seeing similar numbers. We'll be looking at other retail figures and then by way of Target and Lowe's coming out tomorrow. And then there's a few other bellwethers that have yet to report this week. Medtronic, one of the largest or the largest medical device company in the world. Will be interesting to see what kind of uptake they've had in some of those business segments. And then, of course, John Deere, one of the largest machinery companies in the world, seeing what kind of impact this will have on their businesses will be really interesting to see how they're adapting to this. And then, of course, I just said, equities really haven't done a whole lot from this week from last week, but the one, I think, major or bigger thing that's changed from this week versus last has been a really positive Monday performance driven by Chair Powell, U.S. Federal Reserve Powell's 60 Minutes interview, where he, I don't know if you saw that or not, but he appeared on 60 Minutes on Sunday, indicating that they had, other tools in the tool chest that they could potentially pull out. They didn't even know of some tools they may be able to use, potentially all revolving around this capacity to lend. And that sent the market up, something like 2 to 3 percentage points yesterday. Small cap, interestingly, was up 6% yesterday. So that big laggard put in a really big day of outperformance yesterday. But we'll see. I mean, we're still not very enamored with small cap given the valuation issue that they've got right now. And as I was mentioning to one of our advisors, roughly a third of all small caps have zero earnings, which makes the PE challenging, the price to earnings multiple challenging. It's like well above the S&P right now. So we still continue to favor large cap over all other sectors at the moment. This is an interesting chart that I pulled coincidentally from Schwab, Charles Schwab. And this may, I've heard a lot of stories in the media talk about how, the financial economy is really diverting from the, underlying, or the financial markets are diverting from the economy. And I think it goes back to that initial thought I had when we first started Market Matters, which is markets are a discounting mechanism and that it can only be seen in some of this data pretty clearly. Meaning that just when things look the worst, the forward-looking annualized return looks the best. So when unemployment was above 6, the forward-looking experienced S&P gain was actually the highest of any of these segments. I think this is the 5-year forward annualized return from these points. Same as the economy. So that was relating to unemployment, the unemployment rate. You can see here when it was the lowest, the S&P actually performed the least best out of all of this series because it was priced in, it was expected. Looking at real GDP is just a gross domestic product. It's a measure of growth in the economy. When growth is the best, this was really interesting. When growth was the best, the forward-looking return was actually the worst. It was actually negative because when growth looks the best, that usually means that you're near some sort of peak, and that, you know, from here it gets a lot worse. But when it looks the worst or the lowest is when you get that better return prospect, which is obviously very contrarian in nature. And then, of course, S&P earnings, when they look the best, when they're above, expected to grow above 14% or so, S&P is annualizes at a negative rate because all the good of that 14% is likely priced into the S&P at that point. Whereas if if the S&P is pricing in not much growth at all, it's usually the best time to start committing capital to equities or rebalancing because the valuation isn't as challenging. Fixed income, not a lot has changed here. So similar thoughts from last week. Government bond index continues to go sideways ever since middle of March. Investment grade bonds have rebounded a little bit from their recent decline, although not anywhere, nowhere close to the lows we saw back in March, but February, March. But this is still something we're keeping a very close eye on because the investment grade market is the market that most large companies can fund operations through. And then high yield market and emerging market US dollar bonds, that means emerging market bonds that pay their interest and dividends in US dollars, has really been kind of sideways here for a little while. Still don't really have a lot of positive things to say about these two markets. But bankruptcy is starting to become more of a hot topic, and it's certainly been in the news with a number of high profile filings recently. One was JCPenney, which you can see here. Another one was J. Crew, which was, I think, 2 weeks ago. And then Neiman Marcus was actually 2 weeks ago as well. All large retailers had a big footprint in some cases, in the case of JCPenney, and mall outlets. But really, I think what's important to note here is that COVID-19 didn't kill JCPenney. They had been in a long, drawn-out drawdown for the better part of the last 20 years. This is a chart showing their sales or their revenue ever since 2001. And so really all COVID-19 is doing, at least the way I'm thinking about things, is that it's accelerating business either decline or accelerating in other areas. So in this case, JCPenney, Neiman Marcus, J. Crew is just, it's decelerating or hitting their business hard because they're in end markets that aren't very attractive right now. Finally, I was talking about negative interest rates being something we should all think about. Jay Powell in the 60 Minutes interview specifically mentioned that he wouldn't consider negative interest rates, but I think what's important to remember is that Fed chairman or chairwomen, their time is never permanent, and the more combative that relationship becomes with a sitting president, that can be changed. So the markets now have this. What this chart shows is the overnight interest rate. So the federal funds rate for the United States here in green, going back to 2012. The federal funds rate essentially are equivalent for the European Central Bank, which is now you can see negative at negative 0.5%, and the Bank of Japan, which is at roughly 10 basis points. And the only point I wanted to make here was that despite what the Fed Chair Powell is saying, the market doesn't believe what he's saying because there are many things that can happen between now and then. And one of the tools that the Fed could use and that the Central Bank of Europe and Japan have used are negative interest rates. So monkey see, monkey do potentially. And it's going to be, I think, if we do get into that double dip recession period or a second wave that creates a second wave of negative impulse in the economy, and that will certainly be looking to alternative tools to use. Just some takeaways here. I mean, again, very similar to last week. Sideways for now would be kind of our best estimate, but there are ways to make money, and I think that's important to keep in mind, because if you're doing things similar to what we're doing right now, which is being fairly active on the rebalancing front, that can be a way of more or less harvesting that volatility that is in the markets right now. So that's one way to kind of mitigate what's going on right now. And the more you can rebalance during these time periods, typically the better off your outcomes become, because you're selling when the market gets high, you're buying when the market goes low, and then rinsing and repeating. Earnings have been better than expected, so I think that's really putting a boost under certain names or certain parts of the economy, as I've highlighted in previous webcasts. And I think that's a really important dynamic to keep an eye on, because we're certainly accounting for some of these earnings trends, like in healthcare or in information technology or other places, that, you know, if you're in traditional value sectors right now, like financials or energy, materials, and things of that nature, it can be a much more challenging situation. So with that, I'm going to pause there while Mike gets set up. And we're going to introduce you to Mike Townsend. He's, again, the Vice President of Legislative Affairs at Charles Schwab. And he's going to run through what he calls navigating the new normal. So Mike, I don't know if you can hear me, but go ahead and take it away.
Okay, can everyone hear me? Todd, can you hear me?
Yep, gotcha.
Okay, hi everyone. This is Mike Townsend. I'm with Charles Schwab. I'm talking to you from Washington, D.C. and actually came into my office today to promote a more stable connection for this. And my office is about 2 blocks off of the National Mall, a couple blocks from the National Archives and National Gallery of Art. And normally on a spring day, obviously this would be teeming with tourists and people, and I could literally run down the middle of 7th Street without any danger right now. So it's obviously a very strange atmosphere here in Washington, but there is a lot of work that has been getting done by Congress over the last couple of months, and I thought I would focus on some of that today. So to start, Todd, if you could send me to my first slide, I'm just going to show a couple of quick charts, some of which amplifies what Todd was already talking about. But this is, you know, sort of a visual of the rise in unemployment over the last 5 years, and obviously you see that big spike at the end. And then on the next slide, we have, I think this is a really interesting visual. This is the use of public transit in major world cities. So you've got about 10 public transit systems, from the New York subway, the metro here in Washington, and around the world. And you see how strikingly it just fell off the cliff. And it's starting to ease back in some places, but obviously a long, long way from normal. And then Todd, on the next slide, this is always a really interesting one. This is the same day TSA checkpoints at airports. So the TSA is doing over this crisis, you know, something in the neighborhood of 150 to 225,000 checks at airports around the country, when normally that would be somewhere in the 2.2 to 2.6 million per day. So again, just another visual of how so many different parts of our economy have been impacted. And then the next slide is similar to what Todd showed. This is just the S&P 500 since the beginning of the year. I'm about a week behind, so I haven't gotten that little down bump from last week and then back up on Monday. But just some charts to give you some perspective. And if we click to the next slide, I'll jump into the meat of my presentation, which is just a little bit about what's going on here in Washington. So obviously as the pandemic got underway, Congress left Washington, and in fact, the Senate didn't meet in the full body for all of April, and just resumed at the beginning of this month. And it's pretty strange, to be honest. They have they have come back over the last couple of weeks and are sort of working normal sessions, but of course they're wearing masks. There's a lot of members of the Senate who are only appearing on the Senate floor when there's a vote. They're staying in apartments nearby or sort of barricading themselves in their offices. They don't have much staff around. And part of the reason for that, of course, is that the average age of a senator is around 64. There are 48 senators who are over 65 and 14 who are over 75. So obviously in that, a particularly vulnerable population. They've gone out of their way to take all kinds of precautions. And even with that happening, one of the key committee chairs for the Republicans, Lamar Alexander, the senator from Tennessee, is now in self-quarantine at home in Tennessee because one of his staffers tested positive for the virus. That said, they are conducting business remotely on the committee level, so committee hearings and the like. And you may have seen last week when the virologist Anthony Fauci testified remotely from his home, along with other Trump officials. So the Senate is actually doing pretty well at that at meeting remotely. The House of Representatives, which has 435 members, it's even more complicated to get them back in town. And they've actually only been here for 3 different days for voting, including one last week for the HEROES Act, which I'll talk about in just a minute. But obviously, it's much more complicated to have that many members here in Washington. And so they have set up really strict protocols too. The result is that when they had votes last week on the HEROES Act and other matters, they are staggering those votes. So groups of members come in and vote in 10-minute blocks. But the result is that it takes more than 90 minutes to do a single vote. And if that's like a procedural vote, it just is an incredibly inefficient way to do things. But obviously, it's a safe way to do things. So they're focused on that. One of the votes they took last week was new rules to allow during the crisis only voting by proxy, which basically means that a member, say in California, could designate a more local member, say from my home state of Virginia, to vote by proxy. And that more local member could hold up to 10 proxies. And it will allow members to make a decision about whether they need to travel across the country for votes in the coming weeks. Now, the question, of course, is whether there's a political price to be paid for that, to be not, present for voting, that sort of thing. The other thing that they did was change their rules to allow committees to meet by video conference and to take committee votes by video conference. So they're actually behind the Senate in that, but are making some progress now, and we'll begin doing that going forward. We go to the next slide, please. This is just, I'm not going to run through all these, but this is a sort of overview of some of the big steps that the Fed has taken. And I want to just highlight a couple of these various facilities that the Fed has set up. Number one, for individual investors, certainly the money market liquidity facility, which is a throwback to the 2008 financial crisis. So they're able to get that up and going very quickly. There was some volatility within the money market space in March when the market was at its most volatile. And setting up this facility really stabilized the money market space. So money market funds have not had the kind of worry that they had back in 2008 in the financial crisis, and even a little bit in this March. So that was a move, I think, that was very good for individual investors. Then they've also set up a facility to backstop the Paycheck Protection Program, which I'll talk about more in just a minute. That's the small business lending program. And then the Main Street lending program. And just this morning, the Fed Chairman Jerome Powell was on Capitol Hill testifying before the Senate Banking Committee, or remotely testifying. And he said that this program will be up and going by, he said, the end of the month or early June at the latest. And this is a piece that there are a lot of people here in Washington are really eager to have happen, because this is the one that will help mid-sized companies. So the Paycheck Protection Program, of course, is for the 500 employees and smaller types of businesses. This is those mid-sized businesses between 500 and 15,000 employees. So that's an important one for a lot of jobs, and they expect to get that going here in the next couple of weeks. On the next slide, This is an overview of what is now 5 bills that have been passed by at least one chamber of Congress. So we go all the way back to the beginning of March. You have the first bill, $8.3 billion worth of money for research and for Centers for Disease Control, for increasing stockpiles of ventilators and that sort of thing. Now, obviously, in the context of what's going on, a trivial amount of money. The second bill, about $100 billion, mostly focused on paid leave. And then the big one was the CARES Act, passed on March 27th. And I'm going to talk in detail about that in just a second, but $2.2 trillion was the cost of that one. There was an interim bill passed in late April. I don't know why it got referred to as 3.5 here in Washington rather than 4. But it is the fourth bill, and that was to put more money into the Paycheck Protection Program, the small business loan program that ran out of money very quickly in the first round. And then finally, just last week, the House passed the HEROES Act. This is a starting point bill, and I'm going to talk about this more in just a second, but it's got a price tag of somewhere in the neighborhood of $3+ trillion. The Democrats passed it in the House, but it's really a starting point for negotiations. We'll come back to that in a second if we could go to the next slide. I want to highlight a couple of the individual things that I'm sure most everyone is by now familiar with, but some significant changes to retirement savings in the CARES Act. Most notably, the required minimum distributions were waived for 2020. And this was a little confusing, and I know my company is struggling to communicate about this because at the end of 2019, the SECURE Act passed Congress, and that changed the age at which you have to begin taking required minimum distributions from 70.5 to 72. And then just a couple months later, they got waived entirely for 2020. So we've had to send a lot of communication out to make sure that, that everyone understands this. No one has to take a required minimum distribution in 2020. The IRS then eased some of the rollover rules to address people who had already taken their required minimum distribution for 2020. And you can see here, if those withdrawals were taken between February 1st and May 15th, then you have until mid-July to roll them back. However, you're still under what is known as the one rollover a year rule, so you can only roll over one withdrawal. But the HEROES Act, which just passed the House and the House only so far, waived that one rollover a year rule. The reason why this, if it ends up happening, is important is because if you take your required minimum distributions in installments, monthly installments say, you could, under this rule, if it passes, be able to roll as many of those installments back as you want. We're going to be watching that. That has to still pass the Senate. Hasn't happened yet, so still news to come on that. The HEROES Act also waived required minimum distributions for 2019. Now, this is a complex one that we're not sure is going to survive in the Senate, but it would essentially allow you to go backwards and withdraw and roll back any withdrawals you took in 2019. Again, hasn't happened yet in the Senate, so we'll have to wait and see. And then finally, we had the hardship withdrawals. You can take up to $100,000 from a retirement account if you've been impacted by the coronavirus, with no penalty. And then there are rules for paying that back over 3 years. And if you pay that back, you get the taxes back, because when you take that withdrawal, you pay taxes, but no penalty. But if you repay back to your account, you can get those taxes back after the end of the 3 years. So just something to watch. On the next slide, a couple of other key provisions. I think everyone knows now that tax day has been pushed back to July 15th. And I think it's 47 of the 50 states have aligned with that. And that also means that if you are still waiting to make a 2019 IRA contribution, which is usually due by tax day, that too has been pushed back. Other elements of the CARES Act, the IRS stimulus payments, about 130 million of those have gone out to low and middle income taxpayers. Those are the $1,200 checks. And then, of course, the small business loan program. And I show these numbers just to give you a sense of the differences between the first round and the second round. First round, they blew through that $340+ billion in 13 days. But you saw a lot of headlines about larger businesses getting it and some businesses having to return it. The key thing to note is that in that first round, the average loan was $206,000. In the second round, which has not yet expired all of its money. That average is down to around $72,000. What that means is that smaller businesses are getting loans, that the true sort of mom and pop businesses are benefiting from this second round. The concern is that because that pace of those money has slowed down so much, have business owners just given up? Either they're shuttering their businesses, or they just find the program too complex, too glitchy to deal with. And that was something that Treasury Secretary Steven Mnuchin talked about today when he testified at the same hearing with Powell. And he did say that they're planning to ease some of the rules to make it easier for small businesses to not have that money tied up in very specific ways and have better access to it. So I think that's good news coming for small business owners. On the next slide, this is just a quick overview of the HEROES Act that passed on Friday. It passed 208-199. Only one Republican supported it. 14 Democrats went against their party and voted against it. And as I said earlier, this is really a starting point, and even House Speaker Nancy Pelosi has described it as such for negotiations that are going to come with the Senate. But you see here some of the key provisions, a lot of money for state and local governments. That's really the centerpiece of the bill. Another round of payments, a little larger than last time, because in the last time you got $500 per child. This would be a full $1,200 per child, up to 3 children. There's going to be hazard pay for frontline workers, and you see some of the other priorities here. But as I said, the tough work happens now. You got to go to the Senate and figure out exactly what will work with the Republican-controlled Senate. We go to the next slide. These are some of the priorities for Republicans. Probably their top priority in the Senate is liability protection for businesses, and that combined with the Democrats' priority of state and local government funding, which even a number of Republican senators are supporting. I think there's the making of a compromise there with those two items kind of as centerpieces. Republicans have some other ideas that I think are much less likely: a payroll tax holiday, business tax cuts. I just don't think that has much of a chance. And then infrastructure and broadband spending is something that I think will happen later this year, but probably not in this next bill. The Senate is planning to be on recess next week for Memorial Day. So this bill is not expected to be resolved until, I would say, mid to late June by the time negotiations get done. So it's a little ways away still. On the next slide, Todd, I just wanted to go back for a second to the Secure Act, which was approved at the end of last year, just to remind everyone of a couple key changes, notably that folks who have earned income can continue to contribute to a traditional IRA after age 70 and a half. You used to not be able to do that. And then these changes for inherited IRAs, which I think are a significant change to estate planning, and something that Todd and his colleagues have probably already talked to their clients about. But the bottom line is that under the new rules, inherited assets have to be distributed within 10 years. And there are exceptions here for spouses and minor children and people less than 10 years younger than the decedent, which would be like a younger brother or something like that. But the time of being allowed to inherit an IRA from your grandfather and spread that distributions out over your lifetime is ending going forward. You have to do that within 10 years. So it's something to just keep in mind going forward. And then finally, a few other things in that Secure Act, and I just want to highlight one on this page, which is lifetime income disclosure. The Secure Act mandates that everyone receive a little box on their statement that says, here's how much savings you have for your retirement, and here's what that would look like in a monthly income. That is something that is being developed in terms of what that box and information is going to look like by the Department of Labor. They have to put forward a regulation. They expect to propose that later this year. I think it's going to be a year or two, probably 2 years before that actually takes effect by the time the regulatory process is over. But it is something really geared at younger people to try to incent people to save more for retirement and to have kind of a progress report that they can see on how they're doing. On the next slide, Todd, I just wanted to quickly touch on a couple of regulatory items over at the SEC. The SEC is very focused right now, obviously, on coronavirus responses. They have eased some of the public company disclosure rules, made it possible to do board meetings remotely. My company just did its first ever remote annual meeting with shareholders, which was an experience. And then they're very focused at the SEC on scams. And I try to always remind everybody, whenever you have a situation like this, there are scams out there and people trying to take advantage of, companies saying that they're going to deliver ventilators or produce ventilators, and they turn out not to do that. The SEC is being very aggressive at cracking down on those companies and delisting companies that are not playing by the rules. So I think that's a big focus right now. This other thing that I wanted to mention is the SEC has just proposed some changes to the way our market data system works. And that's really the basic market information that every investor looks at, right? The little ticker going down at the bottom of the screen on your financial channels and your bids and asks and all that kind of thing. We at Schwab have long objected that the individual investor gets slower, less quality information than the big institutional investors. And finally, after 20 years of complaining about it, the SEC seems to have heard our message, and they have proposed some rules that will start a process of really leveling the playing field between individual and institutional investors. It's going to take a long time. It's very controversial. The exchanges don't like it, but it is something that that we think is a positive for individual investors. And then finally, the Fed, which is of course really busy, has 2 vacancies at its 7-member board of governors. They've been vacant for a while, and they could get a Senate vote early in the summer. There are 2 nominees that the president has made. They've gone through the committee hearing process, and both those nominees should get a vote sometime later this year, but certainly I would think in the summer. And if confirmed, would put the Fed back at its full complement of 7 governors. Next slide, Todd. And I'm going to wrap up by just talking a little election. This is a slide that I've been showing for the past year of all the Democratic candidates for president, and slowly Xing them out as they dropped out of the race. And as you can see, we're down to 1. So on the next slide, we'll talk a little bit about Joe Biden now as the presumptive nominee. He still hasn't crossed the finish line in terms of securing the nomination in terms of delegates, mostly because you have a whole slew of states that had to postpone their primaries, and there are now a number of primaries late this month and even more in June and even into July. So still have 18 states to go to gather those delegates. Bernie Sanders suspended his campaign, but is still collecting delegates, mostly because he wants to have as much influence as possible on the development of the platform for the Democratic Party, which would normally, take place in the run-up to the convention and then be voted on at the convention. Of course, we don't know exactly what the conventions are going to look like this year, but he has stayed holding on to those delegates, and he has, as you can see, a significant number of delegates. But he is doing that in order to have influence in the development of the platform. And then finally, you've probably seen Joe Biden campaigning from his basement, and it's an unprecedented situation, kind of a tough situation for him in terms of just not having the national platform that your presumptive nominee would normally have. One of the most interesting questions I think that we're wrestling with in this pandemic is just what voting will look like when we get to November. So you've already got 5 states that are entirely vote by mail, but California just became the first state that, as a result of the coronavirus pandemic, is switching to send every registered voter in that state a mail-in ballot for November. It's a huge logistical challenge, obviously 20+ million voters in that state. But they're the first one to do that, and I don't think they'll be the last. You have 29 states that now have no excuse absentee balloting, meaning you can just get an absentee ballot for any reason. You don't have to be out of town or sign something that says I'm sick or anything like that. But that still requires in most states that you proactively go get one. and you've got to, request one. You've got to follow the rules for getting it back. Many states require those ballots to be returned before Election Day. Others have, if it's postmarked on Election Day, it still counts. So it's a huge hurdle to switch to all mail voting by mail. The education for voters is a huge hurdle. The rules are different in every state. Just making sure that you can count ballots efficiently. Do you need to sign? Do you need a witness? Do you need to sign across the back of the envelope? When does it have to be returned? All that kind of thing. The other interesting thing is that from a campaign perspective, absentee balloting starts in most states like 45 days before the election, which means you're going to have voters voting in, late September in some states. Well, that's a whole different idea for campaigns of all types to try to get their information to voters ahead of Election Day, well ahead of Election Day. So all of this, I think, potentially has a pretty significant impact on the November election. So the part of the election that is the most important to pay attention to in some ways, obviously we're all going to be watching carefully what happens in the presidential race, but the battle for control of the Senate is really, really interesting and critically important to determining whether whoever wins the White House can really move forward with his agenda. And that's because we, of course, have a split Congress right now. Democrats control the House. Republicans control the Senate by a 53-47 margin. You see here the states that are up for a Senate seat, and there are 23 Republican seats and just 12 Democrat seats. But 18 of those Republican-held seats are in states that Trump won by 10 or more points in 2016. So it leaves a relatively narrow path for Democrats to win the majority. It runs through Arizona, Colorado, Maine, North Carolina, maybe Montana. And they need to win a few of those seats in order to get to the majority. In Alabama, there's a Democratic Senator, Doug Jones, who won a special election there a couple years ago that was kind of crazy. And that seat is going to be very tough for Democrats to hold on to. So if Republican wins that seat, then you have to find at least 4 seats for Democrats to win to potentially get the majority. And then certainly in Georgia, where I know many of you are, a very interesting situation developing because of the unusual factor of having both Senate seats on the ballot, one for the regular 6-year term and one to fill the term of Senator Isaacson, who stepped down at the end of last year for health reasons. Democrats seem to have some optimism that they can grab one of those seats as Georgia starts to get a little more purple, but that's going to be interesting to watch just because of the unusualness of having both seats open at the same time. And then finally, when we look at 2021, it's really a scenario in which Democrats hold the House, which I think is very likely, win a narrow majority in the Senate, which is possible but not a slam dunk, and then win the White House, which I think is possible but certainly not a slam dunk. That's where you potentially see a lot of potential impact for the markets, and that's because there's a lot of ideas out there on the Democratic side about taxes and banning buybacks and breaking up companies and that kind of thing that are at least in the discussion and only become plausible if Democrats have a sweep and full control of Congress. And keep in mind, and even in that situation, Democrats are not united on all these ideas. I just mean that is the scenario in which these sort of enter the land of plausibility. The big X factor here, looking ahead to 2021, is the staggering deficit that we're going to have. Deficit already estimated at between $3 and $4 trillion, and Congress is going to have to do something about that at some point. And that all the choices politically are bad. You can cut spending, you can raise taxes, and those sorts of things that no one likes to do. So we're obviously a long way, a little under 6 months out from the election, but those are the scenarios where you have potential for the market to react to an election outcome. Then finally, I'll just conclude with this kind of fun chart. Best predictor of an election is S&P 500 performance in the 3 months before election day. It has predicted whether the incumbent party remains in the White House 87% of the time. It's only missed 3 times. If the market is up, then the incumbent party wins. If the market is down, the incumbent party loses. And you see, it's been perfect since 1980 was the last time that it didn't work. As we all say, past performance is no guarantee of future results. This is just an interesting chart. I wouldn't put too much into it. You can draw a lot of connections between the market and the election that work or don't work. This is just one that happens to have worked pretty well. And then finally, Todd, I will just wrap by saying that I am on Twitter and I have a podcast, and the information is here. If you want to hear more of what I'm thinking about and talking about, then that's how you can find me. With that, Todd, I will turn it back over to you to see if there are any questions. And I just want to thank you and the whole team for including me today, and everyone for joining me for a little bit. Thanks.
Yeah, Mike, thanks for those great comments. I think that, I actually didn't realize the market was such a great predictor of election results either. That's fascinating. One question that you didn't necessarily touch on, which I know a lot of our clients have asked about in the past, would be, what's the view, maybe from your perspective or just from what you're hearing, about what's happening with the trade war with China and how that's maybe impacting policy decisions or just the sentiment on the Hill around some of those prickly topics?
Sure, it's actually been really interesting. When you think about it, the Phase 1 China trade deal was signed on, I think it was January 15th, and within a couple of days after that was when really the coronavirus sort of broke into consciousness in terms of people really knowing about it. One thing I would say is that there has been here in Washington a sense of a little bit of a disconnect between the rhetoric at the top from the White House and sort of what's going on underneath. There was a call earlier this month between the U.S. Trade Representative Robert Lighthizer and his colleague in China that both sides said went pretty well. That was pretty positive. China, of course, has, as part of that Phase 1 deal, a set of targets that it's supposed to meet in terms of U.S. imports, and it's behind on those targets. But it's behind on those targets not out of maliciousness but because they shut down so much of their economy in January and February. And I think what was notable was that the U.S. Trade Representative said that he felt that progress was being made, that good faith progress was being made. So while you've got kind of the president using some rhetoric, I think there's a little bit of a good cop, bad cop thing. The other thing I would watch, Todd, on that question is this little spat going on with the World Health Organization, where China has just said that it's going to step up and spend a ton of money towards the World Health Organization, and the president has threatened to take all of the U.S. money away. That's going to be an interesting one. That that there's a little play going on here, right? And who's going to sort of be the influencer around the world? And China is looking at opportunities like that to try to maybe step in to some of those spaces that the U.S. has normally been in. So I think that's the thing I'm watching most carefully.
Right. Oh, fantastic. And I think we've got time for one more question, which came in, which relates to this notion of mail-in voting and kind of the change that will likely have potentially long-term. What do you think the odds are of this actually happening, or is this really just kind of a states' rights issue versus maybe what the federal government would like?
Yeah, it is a states issue. I mean, the states decide, and so that's why you can have, California's governor issue an executive order to say we're going to mail everyone a ballot, so that's going to play out a little bit here in Washington because the HEROES Act, for instance, has about $3.5 billion that is designated to go to states to transition to mail-in voting. But that's really all that the federal government can do. One interesting thing is that there was a special election last week to fill a seat where someone had resigned in California, and the Republican won that race. And it had been a Democratic held seat when the incumbent resigned at the end of last year. And that was essentially an entirely mail-in ballot in one congressional district. But it put to rest a little bit of the sense that mail-in voting favors Democrats, because this was a Republican who did very well with mail-in voting. And so that took a little bit of air out of that balloon from the Republican side. But look, I think this is going to be super controversial, and it's got the potential to make it uncertain who won the presidency on election night, because ballots are going to be counted over several more days. It's got potential to just disrupt voter turnout. It's really dizzying to think about, actually. So it'll be interesting to see how it all unfolds.
Well, Mike, I think that takes us to our time today, and certainly want to thank you for spending some time with us. I know you've come highly recommended and in demand, so we certainly welcome your time today. And I just wanted to wrap up by saying thank you for all the clients for joining us today, as you've all joined us before. One programming note, we're not going to be doing a Market Matters next week, but we'll pick it back up June 2nd. So be on the lookout for that invite, and we might even have another guest speaker on that one as well too, just to bring another voice to a different topic. I think that one's going to be focusing on cybersecurity. So again, thank you for your time. We appreciate your confidence in what we're doing, and I look forward to speaking with you at some time in the future. Thank you.